Welcome back to Power Lunch. Regional bank stocks staging a huge rally this week with the prospects of reduced financial regulation in a Trump administration. The regional bank ETF, the KRE, up 10% this week. Here to discuss and how to trade the big moves in regionals is Chris McGratty. McGratty, did I say that correctly? Head of the U.S. Bank Research at KBW. Chris, thanks for joining us.
Thanks for having me.
So, Chris, I got to tell you, my general philosophy is one should not invest with one's politics broadly in the market, because you end up losing money if you bet the other side or against the other side. But when it comes to sectors, that's a little different. So with that in mind, is this a play here that one ought to take because the politics surrounding regulation are sufficient to justify a long-term investment?
We've seen this. We've seen this trade, Steve. We saw it in 2016. The scramble, if you will, was significant in 2016. I think there's a couple key differences between 2024 and 2016. 2016, we were talking about earnings revisions going higher for the banks because of tax cuts. So earnings went up 15, 20%. ROEs went up 20%. Or 200 basis points, I should say. Today, we're just talking about multiples. And so what was interesting this week, you mentioned the KRE being up 10%. The KRE had its best inflow from ETFs in 10 years on Wednesday. And so that tells you the power the ETFs can have on this market. Mm-hmm. Financials, you make money in financials out of times of change and out of crises.
And so is this 10% it, or is there more to come?
It was pretty quick to reprice risk. We did a note. We looked at where valuations are after Wednesday's move, and we compared it to where valuations have been for the past 7 years. What's interesting is we were within 2 to 3% of historical averages in a matter of a day. Now, you could argue we could push valuations, markets overshoot. We can look back further, and multiples were higher. But the market was pretty quick to reprice risk. In particular, the banks that have had the most regulatory handcuffs, those banks got re-rated the quickest.
Okay, so as I understand it, the president-elect, as soon as he comes into office, can get a new Office of the Comptroller and FDIC. He cannot get a new bank vice chair for bank supervision at the Fed. Is that enough for the president-elect to have, or the president to have, to really change regulation?
We think it's a lot. We think there's as many as 8 changes that could occur within short order. We've done a lot of work on that with our policy team. The biggest one is the handcuffs coming off related to M&A. We've seen really a stalling of several years, not only for the financial services sector, but broad M&A, the restrictions, the time to close a bank deal. If you look back under the Biden administration compared to the Trump 1.0, it was 9 months versus 6 months. So it's 40% longer to close a deal. And the common denominator was a Democratic administration, number one, and number two, the scrutiny from the FDIC. So if the FDIC gets to be more bank friendly, we think mergers are healthy. We need more competition in this sector. That is a big catalyst for the group.
So let's bring this home, Chris, for people at home that are thinking about how to invest in this. It seems to me like the least risky way is to buy the ETF, buy the broad group. But are there stocks within it you think that haven't come along for the ride here that may yet do so?
Yeah, sure. The biggest banks have done the best for the last 18 months. Coming out of the crisis in 2023, there was a flight to safety. We think because of the deregulatory efforts that are in play today, the banks that were on the cusp of greater regulation, so these banks that were bumping up against $100 billion, the issues that brought down a lot of the pressure on New York Community, those stocks have the ability to re-rate. What's happened over the last 6 months is these banks, I see Webster Financial, we'll talk about that. Webster Financial traded at a 40% discount to the peers. That is about a 20% discount today. We think because of the return profile of a company like this, a high teens ROE, 10 times earnings, this is where investors are going to go to play the deregulatory efforts.
Right, Chris, hold on. I got to interrupt you because my understanding is that $100 billion is a rule in which the Fed is involved. Wouldn't they? And are you just saying they could be bought and that would be the catalyst there for better returns? Because I don't know that the Fed they just changed that rule on $100 billion, didn't they?
Yeah, our understanding is the $100 billion, some of the rules are going to keep, right? We think bond losses going through capital will keep when you go through $100 billion. What I'm referring to is some of the most severe earnings pressures, the expense build, the issuance of TLAC, those pressures may not be as significant going forward. Okay. And if that's ROEs are going to rise and not be as depressed.
All right, Chris, thanks very much for your help. And I think that this is an interesting area, but it's a thorny area to go invest with regulatory relief.
Fertile
But
ground.
you may make a lot of money there. I'm not saying you won't, but you got to read the stuff. And it's
seriously,
as the guy who has to report on this stuff along with Leslie Picker here, it's brutal.
Oh, yes, it is. That's how you make money sometimes.
Chris, thankfully, Chris knows about this stuff. Chris, thank you for joining us.
Another